Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different than the news media in America. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is, well, just a few days after the Wall Street Journal wrote an article, and the article was titled, "Good News is Good News Again," referring to the notion that good economic news has been driving the markets forward again in 2023, something that last year, although it is contrary to conventional wisdom, that just wasn't the case. Last year, good news equaled bad news, which of course we covered on this video series almost weekly. You probably got sick of me hearing it. Well, this week we got some great, as Tony the Tiger used to say, we got some great news on Friday, and it was the kind of great news that actually scared the markets into a bad day because of fears of how the Federal Reserve will respond to that great news that we got. Now, what was the great news of this week? Drum roll, please. Brrr. Stick around to point number 2, and I'll tell you more. Friday, we saw the markets retreat for the above-mentioned good news, but also because as earnings seasons continued, the arguably 3 most important companies, they started to report their earnings this last week, and they're the 3 most important companies to the S&P 500, not to the economy, to the S&P 500 because of their weightings in that particular index. Now, Alphabet, which is the parent company of Google and YouTube, probably where you're watching this video, they reported their first drop in advertising revenue since the pandemic began. One interesting note is Google's CEO, he did announce that they'll be rolling out in the coming months their Lambda AI program, which will be a companion to their search engine, Google. Now, this is an artificial intelligence program similar to the popular chat box ChatGPT. If you haven't read that, go check it out, or looked at that, check it out. Amazon also announced this week warnings that their growth will slow because of online shopping and their cloud business, the 2 most important pieces of their organization slowing down. And Apple flagged lower sales of iPhones, Macs, and wearables, which of course brought down their stock. Now, all 3 stocks were positive for the week despite having a bad day on Friday, as you see on your screen. And that was the same story for the markets. The S&P 500, which of course is our benchmark for growth and growth in income stocks, when taken together, not independently, but when together, was up 1.62%. The Russell 2000, which tracks our more aggressive growth, smaller companies, was positive 3.91% for the week. And finally, the tech-heavy NASDAQ, which tracks our more growth stocks in the Dave Ramsey vernacular, that was positive 3.31% for the week. Point number 2. What was this data that was so positive this last month that it moved the markets back into good news is bad news for interest rates and thus the stock market territory? Well, something happened that hasn't happened in the last 53 years. And additionally, we snapped a 5-month losing streak. Now, analysts' expectations were that we were going to create 185,000 jobs in the month of January. In almost a too good to be true fashion, the U.S. economy added 517,000 jobs last month, and that lowered the unemployment rate to 3.4%, hence the 53-year low. Job growth like that and lowering inflation, that's some great economic data right there. However, job growth could be what prompts the Federal Reserve to be afraid of reoccurring inflation, hence stronger interest rate policies. Now, these were the best numbers in terms of job growth since July of last year. And one piece of good news from the Fed's perspective, not so much for workers or consumers, is wage growth continued to slow and soften. Wage growth was still growing, but it only came in at around 4.4%, and that was softer than what we saw in December, where it came in at 4.8%. Wage growth slowing gives the Fed an idea that the consumer won't be spending as much, putting upward pressure on inflation when they spend so much. Another figure coming out Friday that was of note, there were 11 million job openings at the end of December, which is currently about double of the amount of people actually looking for said jobs. And finally, the weekly claims for unemployment insurance, which is a number we typically look at each week on this video series because they come out weekly, so it coincides well. That came in at 183,000, their lowest level since April of 2022. Point number 3, I'm in the no recession camp, at least based on economic data that we've seen over the past few months. And you can watch all of our previous videos to hear some of my arguments as to why I'm in that no recession camp. In my opinion, the 3/4 of economists that are predicting a recession have a mild case of groupthink. Now, let me give you one additional nail in the coffin to the 2023 recession. State budgets. State budgets? Oh, golly. John Mark has gone off the deep end now. No. Let me explain. Our clients primarily hail from the states of Ohio, Texas, Florida, Georgia, South Carolina, North Carolina, West Virginia, and Pennsylvania. Of course, we have more than just those, but those are our primary states. And each of those states, as does any state in the U.S., needs to have a balanced budget each year. This is different than the federal government, which can run deficits or spend more than they make with money they don't have to impress people that they don't like. But in the state government, you have to have a balanced budget. Income have to meet equal expenses. And when you have a balanced budget, that means a decline in revenue would force you to make cuts when you do enter an economic slowdown, which of course is going to lower revenues. Now, state governments account for about 13% of our total employment, including many of our own clients. So if they're forced to cut employment, of which they're a major contributor of employment, because of an economic slowdown, it would exacerbate the problems of that economic slowdown, leading to even more pain and deeper problems, hence even deeper recession. That's what happened in 2008 and 2009. Now, this may not be a problem this time around. Why? Moody's Analytics estimates that about 39 states, they currently have the reserves necessary to offset any revenue decline that would be lost in a mild recession, and 4 additional states are knocking on the door of being there. Now, there are 2 main reasons why state governments are in such a good place from a budget perspective, a rainy day fund perspective. First, we've had such a strong economic rebound after the pandemic that tax receipts were well above what they budgeted, nearly about 20.5% above budget, and that allowed a lot of money to be pushed to rainy day funds. Secondly, round after round after round of fiscal stimulus put about $900 billion in state coffers, of which 20% still remains unspent today. And there's a time limit on that. It's 2026. So if states see a decline in revenues and need to either cut staff or use their rainy day funds to balance the budget, then having a large pool of money, some of which actually needs to be spent anyway in the next few years, would provide a level of stability to that employment situation that leads to no recession, in my opinion. Now, for an additional case for no recession, my wife will tell you, I'm very stubborn. So maybe there is some strong data out there that's suggesting that a recession's coming, but I'm just not seeing it. Or, as my beautiful bride would suggest, you just don't want to see it. Now, let's go to point number 4. Nick Timiraos. He's a guy that you want to watch from the Federal Reserve's next move perspective. Why? Well, he's a Wall Street Journal Fed reporter, and he has been the guy that has been spot on with giving preemptive signs to what the Fed will do next. If he tweets it or he writes about it, it ends up happening, giving us a pretty clear view. He's got somebody on the inside. He's got some good sources. Well, in last week's Fed meeting, he asked the question everybody's been thinking, so maybe he was asked to ask it. And that question was, can the Fed simply pause its current rate cycle, not increase rates anymore, and just wait and see what happens? Well, if these higher rates have their needed impact on slowing down the economy, that's good. That's what we want. We just don't know if that's going to happen or not. Jerome Powell gave this answer to that question. He said he thinks the greatest risk to the Fed and the U.S. economy is just not doing enough, is seeing inflation come back too aggressively. So if he's too aggressive against inflation by raising rates too high, too fast, and not letting them just wait and see what they can do, and starts to kill the economy, he says we have other tools at our disposal to reaccelerate the economy. Thus, victory over inflation is priority numero uno. The CME Group, they have a Fed Watch tool that we've talked about before, and that currently gives the best odds of a rate hike with only one more in 2023 at their next meeting in March of 0.25%. But based on that last comment from Fed Chair Jerome Powell, I'm not so sure that that may be all they're going to do. And if there's more rate hikes to come, that could lead to more instability in the stock market, which after a great January, and as we just saw in point number 1, a great start to the month of February, would be a little different than we've experienced so far. But thankfully, with strong returns, we've got a little bit of a cushion for 2023 so far. So if you enjoyed the 4 things we learned in the markets this week, would you do us a favor? Would you do us a favor by subscribing to our channel so that when we release these videos, they can be pushed right out to you, as well as liking the video. Liking the video tells YouTube's algorithm that our content was helpful and valuable to you, and thus it pushes it out to more people so that we can help more people live and give like no one else. And of course, if you would like to meet with any of our financial coaches who work through baby steps 1, 2, and 3 with you to get you on a budget, to help you get out of debt, and maybe most importantly, to be that accountability partner for you as you work through those steps, click on that button to schedule a meeting with either of them, or you can also click on the button to meet with any of our financial planners, and our financial planners would be more than happy to help you work through baby steps 4, 5, and 6 so that you can start executing and begin to live and give like no one else. As always, we thank you so much for watching this video, and we'll look forward to seeing you next week.